So first of all, they were too late and now they're too early. It's the ratings agencies. Criticised for missing the fact that the likes of Enron, Lehman Brothers and a whole load of subprime providers were about to go bust a few years ago. Now European politicians are all over them for being too quick to pull the trigger and put the likes of Greece, Ireland and Portugal into the junk basket. So they're in the press a lot, probably not for the reasons they want to be. So who are they? What do they do? And what are the alternatives? Are they still useful? Okay, so what do ratings agencies do for a living and who are they? Well, essentially, they issue opinions. They tell the market what they think of, well, anything actually, but primarily bonds, but they'll happily rate pension schemes, governments, and a whole range of other things. So, who are they? The big names are the two American companies, Standard & Poor's and Moody's. And then, of course, there's the European headquartered Fitch, who are also a kind of third player in the market. Now, between them, S&P and Moody's are about 40 to 50% of the market. Fitch, maybe another 15 or so. And that means there are some small players out there too. And these are all privately owned organisations. So S&P is not part of the US government, for example. It's privately owned, privately run, and makes quite a lot of money. How much is difficult to tell. Moody's, we know, has annual turnover around $2 billion US dollars, so there's clearly money in being a ratings agency. Now, what is it they actually rate? Well, that can be broken down into essentially two slices of business. As I say, they do more than just two things, but they're known for rating, in particular, corporate debt or corporate bonds. And recently they've got into the headlines for giving an opinion on whole governments and countries. Sovereign debt. Now, a crucial difference between these two, apart from the fact these are issued by companies and these are issued by governments, if you like, is the fact that the ratings agencies get paid over here and they don't over here. So in the corporate debt market, they make money two ways. And one of them is slightly controversial. Some people think a bit of a conflict of interest coming up. The people who give them a lot of money to rate their debt are bond issuers. So the likes of Tesco or General Motors might pay a fee to S&P and or Moody's and or Fitch and have them rate their debt. And we'll look at what ratings are in just a moment. So issuers pay them and so do subscribers. Nobody says you have to use ratings agency information, and indeed quite a few hedge funds don't. But you can pay to get access to the sort of information that these agencies produce. Now, chances are Tim Bennett's not going to pay for it, but the bigger investment banks and fund management groups happily will. So, on the corporate debt side, they're making money for giving opinions on sort of two sides, if you like. Over here, they do it for nothing. Now, nobody does anything for nothing in the financial markets, so they're clearly doing it for the publicity, but it's free. They don't get paid by the Greek government to tell the Greek government that they might be bust. So, in other words, this side is really more PR and marketing. This side is the bread and butter, nuts and bolts of their business. Okay, so that's roughly what ratings agencies do, but more specifically, what does a debt rating mean and why does anyone care what it is? Well, first of all, why do we care? Let's deal with that one first. And the answer is the quality of your debt, as adjudged by these big agencies, affects how expensive it is to service and how expensive it is to issue, or even whether you can issue any more at all. Don't forget that bonds and debt is just IOUs issued by companies. So here's the way it works. In very crude terms, you might have, say, a 5% bond redeemable in 2020. So there's a tradable IOU issued by a company, let's say, and in another video I deal with how you get from here to the yield, so I won't hammer that here, but let's say the yield on this bond is 6.5%. Now that yield I cover in another video, Bond Basics Part 1, and that's a function of basically the income you get from the bond, £5 a year, and any capital gain or loss that is the difference between the current market price and what the bond would be redeemed for. But as I say, anyone lost there should check out one of my other bond basics videos. But here's the point. Ratings agencies' opinions can directly affect this. Now, the yield is what an investor's interested in. The higher the yield, in theory, the better the overall return. But the issuer is also interested for the opposite reason. As an issuer, you ideally want your bonds to carry as low a yield as possible because that makes them cheaper to service and potentially makes it cheaper to issue more. Plus, more likely, you can issue more. So, overall, this is the relationship, crudely speaking. If a rating comes out, and we'll look at what those are in a moment, that's an improvement on the previous rating. Usually what that will do is encourage investors to buy the bond. So because it's fixed income, the price will move up, and that tends to suggest that the yield moves down. So the higher credit rating you can attract as a company, or indeed as a government, generally speaking, the more popular your bonds, and the lower the yield, i.e. the cost to the issuer. So that's kind of what's in it for the issuer. You know, they're looking for credit ratings agencies to rate them well. They're prepared to pay for that. They pay a fee, a subscription for that rating, and the better it is, the cheaper and easier it is to issue debt. Okay, so what does it mean? What is a rating? Well, let's take a look at, say, Standard & Poor's as an example. Ratings go from, on a sort of scale, the highest you can get from any of the agencies is AAA. Now, Standard & Poor's and Fitch tend to use capital letters. AAA, top quality. Government standard, if you like. Governments like the UK and the US keen to hang on to their AAA ratings if possible. And some top companies can also issue debt that's AAA too. Now, Moody's use a capital A and two small a's because they're a rival, but that doesn't matter. AAA is the top rating. Down the bottom, the one that everyone fears, D, the default, if you like. That means you are missing interest payments on debt, you're not repaying your debt. That is pretty bad news for fairly obvious reasons. And that's the lowest rating they give. And in the middle, you've then got graduations following the kind of letters A to D. So you can have 3 A's, 2 A's, or a single A. You can have 3 B's, 2 B's, or a single B. 3 C's, 2 C's, and a single C. And basically, the further down the alphabet you go, the less creditworthy you and your bonds are deemed to be, so the more expensive they'll be to service an issue. Now, in the middle, just a few points to watch out for. In the middle, there is something called a BBB rating, roughly in the middle. And Standard & Poor's like to graduate debt between AA and CCC with a plus or a minus. So, you could have bonds rated BBB minus. And at that point, you really hit the cutoff for what's called investment grading. And that matters to both issuers and fund managers. Basically, once you stray below BBB minus, you're into junk, you're into non-prime, to give it its other terms, you're into non-investment grade. And that matters because some funds won't hold non-investment grade debt. So that's quite a sensitive cut-off point. And just be aware the minus is just a graduation of BBBs. You can have BBB plus, BBB minus, or in the case of Moody's, you can have BBB1 or BBB2. They use a slightly different scale. But a bit like being at school, there are quite a lot of grades in between AAA and D. Okay, so that's worth bearing in mind. The other thing that ratings agencies do is rather than change ratings on a particular bond, they can issue an outlook. And recently they've been doing that for whole economies like the US. So they can say, well, our outlook at the moment is either positive, stable, or negative. And that is not a ratings change alphabetically. It's just a view of what might happen in the next 6 months to 2 years. So if your outlook changes from stable to negative, what it means is watch out, because as an issuer you may be facing a downgrade next time around. So that's some of the language around ratings agencies. Now, what do they look at when they do a rating? And the answer is a whole range of factors. But it's worth bearing in mind that the actual rating is a function both of the issuer and the debt or the bond or the IOU being rated. In other words, it is possible basically for quite a low-grade issuer to have quite highly rated debt, because basically a bond can be secured. An IOU can be secured against companies' assets, like property, for example, and that increases its safety factor and uprates its ranking, or its alphabetical grading. Issuers vary too. Some companies are big, well-known, good profits, good cash flow, stable management, and they can attract high ratings. So the overall rating is a function of who you are and the paper you're trying to sell. And those two things are considered in tandem by the ratings agencies. Now, they're a bit cagey about what they do, but in essence what they're doing here is they're talking to management, the squidgy stuff, trying to make a judgment call on the way the company's run, and then they're looking at other things like ratios. They're going through the profit and loss account, the cash flow statement, doing some number crunching to come up with its opinion on corporate issuers. What about governments? Well, they're a little bit cagey to tell us exactly what they're doing. They like to keep that all top secret, but they're looking at economic stability, political risk, because ultimately government debt is paid by taxpayers, so riots and a dodgy tax system don't help. They're also looking at things like foreign currency reserves, how transparent the market is in Greece or Ireland and so on. So a whole host of sort of economic markers being thrown down there. But the bottom line is, I can't tell you specifically how you get to a debt rating. I can't say interest cover must be at least 7 times, because that data isn't usually available. In other words, the agencies are quite secretive. Okay, so we've looked at who they are and what they do. The question is, should the system change? Critics would point to several obvious things. First of all, as I said at the beginning of the video, they were late to realise that Enron was about to fail, Lehman Brothers was about to collapse, and also that a whole raft of subprime bonds were about to go completely belly up. And they were a little bit lax when it came to grading some of those bonds. Just because you put a load of dodgy bonds together, mortgage-backed bonds with a couple of good ones, doesn't mean the whole lot suddenly becomes highly rated just because you've mixed good with bad. As someone once put it, you can stick lipstick on a pig, but you've still got a pig. So basically criticism would be, well, they were too late with corporate problems before the credit crunch, and now they're too early. Other criticisms would be, why only 2? It's a bit of an oligopoly. Okay, there's Fitch, but Standard & Poor's and Moody's do dominate the market. Next criticism would be, can you have zero conflict of interest where you are paid by the people you are rating? So in the corporate market, these agencies, remember, are paid a fee by the people ultimately whose debt they are rating. Some people would say that can't work. How can you be independent in that situation? And of course politicians have jumped in recently and said, well, this is ridiculous. We can't have these big powerful agencies randomly deciding that Greece is bust. That's causing havoc in the Eurozone. They could derail the whole project, and then I'm not even paying them to give those opinions. So what would be the alternative? Well, some kind of government agency in Europe, but frankly, would you trust the government to do a job the private sector already does any better? The answer is no. I personally wouldn't. And besides, some people would say at the moment ratings agencies are too easy on their corporate clients who pay them and too hard on sovereign ones who don't. Put in a political body and you'd find the reverse was probably true. At the end of the day, call a spade a spade. If Greece is bust, why doesn't everyone just put their hands up and say that's the reality? And some people would say that the ratings agencies should be praised for at least getting in there and saying what everyone suspects about European states. Finally, would ratings agencies disappear tomorrow? Unlikely, because fund managers like the fact they can outsource key decisions about whether companies are good or bad to these external agencies. So they're here to stay, they're far from perfect, and at the end of the day, we're probably not going to see that big a change in the way the market's organised.